Unlock your potential with a comprehensive suite of investing tools and expert education with GammaEdge. Start your free 14-day trial today. Yeah, so in reading the market heat map in the background thread, I see Gex Ratio is being used as sort of a sweet spot. The idea being for it to fall, stagnate, and turn back up, but not pass, I think, is the impression I got, that it was a concept to treat Gex Ratio as some sort of RSI of gamma. So relative strength indicator. Challenge the idea or agree in some nuance. Would you treat this as sort of a signal? Is there something specific needs? I don't know, Mike Taylor, you wanna start?
Yeah, I can. Again, I'll tell you the way I use it. Back to that thing I was talking about. What is it? Where are we relative to transition? What is the cumulative tick doing? Again, slapping on. What is the Gex ratio doing? Another one I have is kind of what is the long portfolios that Michael's running? Like the PGEX to PTrans to PGEX. Are those firing? Are those not firing? So recently, it's below transit, taken downwards. There's been no activity in the long only portfolios, and Gex ratios are not looking great either, and that's why. But specific to the Gex ratio, yeah, again, I don't trade specifically off a Gex ratio, like a Gex number. I know Dan's doing a lot of work there, so he can chime on a lot of good content there. The way I use it is, I guess you can kind of, I think of it, I guess, more or less as like an RSI of gamma, meaning when we're getting down, to the 0.6 area, and price is kind of sticking around negative Gex. Negative Gex isn't really going lower. Then I'm not super interested in looking short, because I've seen time and again, those kind of conditions prime to get your face ripped off to the upside. Kind of likewise, the upside, when the Gex ratios get pretty heated around, 1.4, 1.5, I'm not really wanting to super aggressively press the gas there, because up towards plus Gex, and plus Gex is higher anymore, so kind of stagnant, running out of steam, kind of drift lower. So, I mean, in a way, yeah, that is kind of how I look at it, for lack of a better.
What I'm hearing is, yes, it's kind of an RSI. It is kind of its own independent signal. Obviously, it's not a signal on its own. You want to look for other things. Yes. But it's like the last couple of days are a good example, where we had several transitions that went really strong negative, but then you saw the Gex ratio turn back up. And so that's kind of misleading. You have sort of a long signal from Gex ratio and a short signal from the overall in the money, out of the money, put call dominance on the plain side.
I don't know if I'd really look at it as like a go long signal, just because it's really low. I view it more as of
definitely not on its own. I definitely don't want to suggest that it on its own is a trigger to enter a trade, but as a pure signal of bias or of extension, the impression that I got was that, yes, if you are looking to go long, you want to see Gex ratio rising. You want to see ideally it rising from a low place. You want to see, ideally, it rising in alignment with the overall plain dominance that you see. Is there anything off about that?
Yeah, like in a vacuum, I think you're right. The closer you get to 0.6, I mean, the backtesting shows the risk to reward to the downside is not as favorable as the risk to reward to the upside.
Is 0.6 a hard line in the sand, like normalized verbatim, or is it relative to something?
I'll let Paul speak to the specifics of the 0.6.
Okay. So the short answer is the 0.6 is more appropriate for ETFs than it is stocks. Many stocks never go below 1. They're just like in this perpetual, everybody is call dominated on these things. The 0.6, 0.5, 0.7 for the SPY, the Qs, the IWM, which was the original detailed testing methodology, work the best for producing consistent results. And so what that's telling you is you're buying when people are fearful, because puts are greater than calls. And this is different than PCR, put-call ratio, which it is mostly attuned to, put-call ratio being literally what it says, whereas Gex ratio is tuned to the duration of really, because gamma has a time component that decays the further you get away from it. Gex ratio is more of a expression of what's impacting us right now. So if you're going to look at the SPY, the Qs, the IWM, I think many of us here, we've chuckled about it in the past. We've chided ourselves for not buying long-dated calls or some upside structure when the SPY or the SPX has fallen into 0.4, 0.5, or 0.6, because it doesn't stay there forever. IWM gave us a test of our metal several months ago where it stayed at 0.5 and 0.6 for months. And if you were in that trade, you would have lost money. Gex does not infer price. It infers the ratio of short-dated puts to calls. And so if you're going to have a sustenance of puts dominating, prices are falling generally. And yes, you're going to get toast. So Dan's use of Gex ratio, it is the number that he shows in his charts, is very, very useful. And I agree, Siam, 100% that you want to use it in conjunction with other things that you may see with respect to the ETF or to the stock. The other thing that I want everyone to be aware of with the Gex ratio is our thinking. It has not been invalidated. I'm not pulling the rug out from anything that we've done with Gex ratio. In fact, I still think I look at Gex ratio daily on almost everything. Where our thinking has shifted a bit is that we want to see a movement in Gex ratio correspond to a movement in delta. And that gives us this. When we originally did the Gex ratio studies and analysis, we had not yet mathematically shown or numerically shown through quantification just the whole concept of left-hand plane, right-hand plane, and all of that. Since then we have, although we haven't written a white paper on it. There's a clear correlation that the movement in the left-hand plane and the right-hand planes and delta are correlated with a change in the Gex ratio. So what does that translate to something we can do here that's really important? Whether it's an ETF at 0.6 or it's a stock at 1.1 or 1.2, when you start to see out of the money calls go in, those typically are not leaps, right? They're not 6 months away or whatever the case may be. Those are typically shorter dated, 3 to 4 weeks, maybe out to the next monthly, whatever the case may be. And that's within that window, that RSI, Gex RSI type of time frame horizon, right, where you still can have some influence. And why that's important for us is that's telling us that speculation is starting to go in. And when you see Gex ratio move up, it's due to the ratio of short-dated puts and calls changing, and in this case, calls going in and or puts being closed. What do we know that looks like? What does that look like in our, out of the money, in the money, put call architecture that we've been developing here now for a good or better part of a year? It looks exactly like the bears getting scared below, a reduction in puts, out of the money puts being closed, as well as the bulls being emboldened, calls going in, out of the money, increasing the ratio. So the Gex ratio can be used in conjunction with this whole concept of moneyness, the left-hand plane, right-hand plane, all of that. And I think what Dan is doing by putting the Gex ratio on there, if you start seeing a series of low Gex ratios, red numbers, for instance, and then perhaps moving to the yellow or the oranges and then eventually going green, you're probably going to see them correlated with an increase in the ratio. The flip side of that works too. You're in green, all of a sudden you start seeing yellows or oranges or perhaps even a movement to the red. You're going to see the Gex ratio come down. It makes absolute perfect sense when you start thinking about the mechanisms that are there. So I would urge you, if you're going to look seriously at Gex ratio, whether it be on the ETF side or on the stock side, you want to look at kind of the history of where you've been and start looking to see, are we starting to see call or put speculation that's going to change something? Is that useful?
Yeah, no, very much. Thank you. What I've been trying to do was I use your spreadsheets liberally. I was trying to see if I could reduce effectively the plane dominance and some other factors into almost a scalar value that you could create into sort of an RSI. But what I'm hearing is that the Gex ratio kind of is doing that on its own, and perhaps merged with Vol-U, Vol-D, or Vol-D particularly, over time, that might maybe lead to a very strong idea of where the overall positioning is moving. And I would love to see that that enter into a merged value eventually. Is that fair?
Yeah, no, it's very fair, and I just made a little note here to think a little bit more about that. To me, when we created the RSI, it was out of frustration that people were relying so heavily on PCR. Or not RSI. When we created the Gex ratio, people were relying so heavily on the PCR, put call ratio. And so with EdgeRater, I have the ability to directly look at put call ratios and do it for 10 and a half years on a daily basis. And a lot of people put, the put call ratio is bearish and we're going down. No, not necessarily. Put call ratio is bullish and therefore, everybody is going to drive the stock up. No, not necessarily. You can still be above 1 and falling, or you could be below 1 and rising. And time frame matters. My favorite example that I like to use is that if I open 50,000 contracts of next May, I just boosted, or call contracts, I just boosted put call ratio by 50,000 contracts, and it's going to bias you to think, hey, something important's happened. But in the reality of things, those 50,000 contracts for next May, especially if they were a 5 delta, is a drop in the bucket. Doesn't mean diddly. So our Gex ratio gets around that. And so I'll just leave you with that thought.
I get it, and I will continue experimenting. I like it.
Sure, and don't hesitate to ask questions. I've spent way too many hours looking at it, and Dan's, he's surpassed me in some of the analysis. So between Dan, myself, and others, I'm sure we can probably get the answer to your question. I don't know if that addressed everything that you were asking for. You said it was.
You did. No, thank you. I appreciate it. I was trying to figure out if I understood it correctly as it was expressed in the thread, and whether or how to interpret it kind of on its own as a signal. I think I can. And obviously it's not a trigger and a signal on its own, but it is a generalization of a lot of data that gives a bias.
So let me just leave you with this thought. If I were to buy a 2x bullish ETF, say the SSO, which is the 2x on the SPY, and so I'm taking options out of the equation in the discussion here. I'm just saying I'm going to buy equity on the bullish side, and I'm going to increase my exposure every time the SPY goes from 0.6 to 0.5 and to 0.4 to 0.3, and maybe I'm going to double down each time. So I'm going to buy one lot, when it goes from 0.7 to 0.6, I'm going to buy 2 lots when it goes down another 10th in Gex ratio, and et cetera. I don't know if they were in the white paper results, but the end results are that type of trade will be profitable. You'll take a lot of heat, and that is documented in that paper. But you will be profitable, and the reason is we always go back over 1. We always go back over 1 in the major indices. And so the SPX and the SPY and the Qs recently hit some pretty low numbers, and I didn't participate. I didn't go grab them. I know I'm going to have lack of buyer's remorse, ignore remorse here, because every single time in the last year and a half when we've dropped and we've not bought long dated or feathered our nest with some of these longer core positions, we always kick ourselves in the ass when the thing goes up to 1.2, 1.3 and could have been a double or something like that. And with options, it could be even more. So you just got to give yourself time. And I think as you look at it in the context of how do I give myself time? I want sensitivity, so I don't want to go too far out in time, right? I don't want the extrinsic value to be so weighted in time that it doesn't move in stock price, that it's liquid out wherever I'm at. But we also put that date in there. We put that time in there for the average days to get a certain level above. And so you have a guide. That's why we created it that way. You have a guide for average days out, and you should be looking for as target levels